The government is once again seeking to raid the local market in a bid to raise 50 billion shillings despite under-subscription of government bonds in the recent weeks as financial institutions, which are the biggest investors in government securities, retracted back to loans. This has been necessitated by the repeal of interest rate cap last year. According to CBK, out of the 24 billion shillings worth of treasury bills issued late last month, the government received slightly over 4 billion shillings, raising fears that the government might default on its loans. The minimum subscription for the two issues is set at 50,000 shillings. The 5-year bond will attract an 11.304% interest per annum, while the 10-year will attract 12.438% interest, with the interest repayment for both loans set to start on 24th next month. To woo more subscription as a possible last resort, the bond will be rediscounted at 3% above the higher of prevailing market yield or coupon price, though the central bank did not expound on whether exactly the money targeted will be channeled to the fixed 5-year and 10-year bonds is expected to be part of the 289 billion shillings the government seeks to raise from the local market to fill part of the 607 billion shillings deficit, with the remaining to be borrowed from the foreign markets. Last week, Treasury Cabinet Secretary Ukur Yatani said the government will this year borrow 150 billion shillings from the domestic market. The money raised from the venture, Yatani said, will go towards funding only projects with diverse multiplying effects such as agriculture and manufacturing. The 50 billion shillings loan will further aggravate Kenya domestic debt towards the 3 trillion shillings mark.